Okay, so very good morning. Welcome to the briefing then for Wednesday the 27th of July. Quite a bit of individual news flow I want to cover this morning. So I'm going to kind of move straight on to the first story, which is relevant for the global markets, and that's Japan and some news that's happened overnight. And this, of course, is the prelude to the Bank of Japan, which we'll see with their announcement on Friday. Overall, some moderate risk on this morning. Stock futures seen slightly higher, but fixed income also higher in terms of bond futures. And this comes again with the kind of expectation of central bank assistance to help prop up the market. There's been a couple of interesting earnings reports. Apple, we'll go into that in more detail shortly, but they've traded as much as 7% higher after market close yesterday. You've had the likes of BASF in Germany. Their second quarter profit missed analyst estimates at the world's largest chemical maker, but I believe their outlook was a little bit on the better side than what analysts on the street were forecasting. So quite a few earnings reports. As I've said before, if you follow our Twitter feed at Amplify Trading, I do tweet out all the corporate earnings in the morning that are relevant for the market. Moving on then, let's take a look at the Japanese yen first, because we've seen some very sharp price movement in the overnight session. First of all, this is from around 3 o'clock this morning. You had some very aggressive weakening in the Japanese yen, and we moved from around the 105 handle all the way up to highs of 106.33. So why did that happen? And then why have we seen a pullback more recently? So starting with the initial weakening of the Japanese yen. So the big thing about the Bank of Japan, which is slightly different to some of the other central banks at the moment, is that Japan are looking at a fiscal stimulus in addition to monetary easing. Again, the majority of analysts are expecting the Bank of Japan to trim interest rates further into negative territory this Friday. But this is coming in combination with, as you can see from that headline, the prospects with Shinzo Abe overnight will look to push through a fiscal stimulus package exceeding 28 trillion yen. That's around 265 billion US dollars. Now, you heard some of the press reports we've been covering over the last few days. The package has been rumoured to be in around the 20 to 30 trillion range. This obviously is more towards the top end, which is likely to have caused some of that aggressiveness of the weakness in the yen overnight. The stage has been set then, lining up for the Bank of Japan, whether or not they can deliver suitable easing as well to satisfy the markets. Now, as you can see from the Japanese yen, though, we have already recovered pretty much, I would say, 80-90% of that initial move. Now, why did that happen? Well, the reports essentially, some of it got denied already overnight. So the yen paired some of its declines after the Ministry of Finance denied a report that came out in the Wall Street Journal suggesting Japan was considering sales of 50-year bonds. So it seems to be a bit of a case of, as it's written here, buy on rumour and sell on fact. It's quite an often type of price action that you see, and we have already, with source comments and the like, seen a lot of toing and froing between news articles coming out citing sources, and then quite quickly the likes of ASO coming out and denying that being the case. So with this though, the question mark and the big question mark is, how will the market take the BOJ's action on Friday? Now, let's assume that they cut interest rates, which I believe is around 80% priced in by the market. If that occurs, in addition to this 28 trillion fiscal stimulus, is that enough to get the yen to reverse from some of the strength that we've seen, more akin towards this 100 level in dollar yen? And obviously, this is critical for the outlook for the Japanese economy, because the yen is a safe haven asset, and the more pain that's felt in the global economy has strengthened their currency, and that hurts their economy because the currency is too strong, and that hurts their exporting names. The index weakens, and there's a loss of confidence in the domestic market. So there's a lot of pressure on at the moment, and what we've seen of late is disappointment more than anything. Every time the Bank of Japan has done something, this looks awfully familiar to when the Bank of Japan took the unprecedented step of taking interest rates into negative territory for the first time. We spiked up in dollar yen, and then within one day we'd recovered the move and were moving lower, and we've moved lower really ever since. So very short-termist in terms of it having a sustainable impact. Hence the reason why Friday is really going to be key on how the Bank of Japan can manage those market expectations. Sticking with the central bank theme, obviously one of the big things today is going to be the Fed. We have the FOMC statement at 7 p.m. this evening. Now, important to remember, this is not the dot plot matrix update, no new projections, no press conference with Janet Yellen. This is purely 7 p.m, statement hits the news wires, and then the market reacts, and then usually there's some short-term volatility and the show's over, barring anything unexpected. So, a quick look then, what to expect from the Fed this evening. You know, if you remember around 2 months ago, we were debating in the morning briefings, are the Fed going to hike in June or July? And obviously, given Brexit first and foremost, the situation has severely changed from where we were just a short time ago. Looking at the federal funds futures to see what the market is pricing in the short end of the curve, there's only around a 2.4% probability that we'll see an interest rate hike from the Fed. Remember, counter to the Bank of Japan, the ECB and the Bank of England, the Fed cycle at the moment is about when or if they will raise interest rates at any point this year. So in terms of an interest rate hike today, the expectation is pretty much non-existent. Only a 2% probability the markets are counting on that. So what is going to be key for the Fed today is the language and communication of their statement. Now, this is a tool that I know some of you probably will be familiar with. You might have seen it before. This is the Fed Statement Tracker by the Wall Street Journal. Now, this is a very useful tool that I suggest that you use if you are looking out for the statement later on, because what it does is it updates within around a minute, and it gives you can select the month-to-month change then in the language. It basically strikes out the previous wording, so you can compare the subtle changes in language to what the Fed are trying to tell you for their near-term kind of outlook. Now, with the Fed statement comes out tonight, the real key area is going to be this first paragraph. Now, the Fed statement always follows a fairly routine kind of structure. It talks about jobs market, talks about inflation, it talks about growth, and then the overall committee's kind of decision. Now, the key area here very much is the jobs situation. Let me quickly remind you of the state of play of US non-farm payrolls. So the white line is the monthly change in US non-farm payrolls. Remember that last reading we had? 287,000. That was against 11,000 the month before. You know, these are, looking back all the way to 2010, you've pretty much had your worst and your best reading in the last 2 months. Now, for me, from a policy perspective, that's quite worrying because there's no consistency in that data. The key thing for me then is that when the last meeting happened for the Fed statement, we were in a situation where jobs were at their worst state since 2010 at 11,000. Now we know that non-farm payrolls spiked back up to 287. As such then, the key area where the language I'm expecting to change is around this part here. The pace of improvement in the labour market has slowed, while growth in economic activity appears to have picked up, although the unemployment rate has declined. Jobs gains have diminished. That's key there. That, for me, has to change. The situation now is starkly different from the last data that we've seen. However, I would think that they'd like to be a little bit cautious given the volatility in the data set of non-farms. But certainly, job gains have diminished. I think that needs to be updated from the Fed, and how strong a wording they use on that will be key and will be what traders will be looking at to trade. A quick look then at what one of the not central bank, but an investment bank are looking at, and I agree with their stance, is Bank of America, expectation for the Fed to keep rates on hold but leave the door open to hikes later this year. Now this is really key because I think from a Federal Reserve point of view, you're in quite a good position at the moment. If you think about data in which we had yesterday, you had the likes of consumer confidence, Richmond Fed manufacturing, US new home sales, all were very strong, certainly much stronger than expected. And US consumer confidence to not take any kind of hit from the concerns emanating out of the UK and the potential slowdown that would have in Europe, or the crisis on Italian banks, they remain unfazed. So you've kind of got a more underlying positive situation that's coupled with the strong jobs data, and the Fed have the benefit that there's forthcoming monetary stimulus from the Bank of England in August, likely in the form of an interest rate cut as a minimum. Bank of Japan on Friday likely to cut rates and possibly do more. And then you've got the ECB likely to tweak QE and broaden out their program. So for the Fed, does this mean that the other central banks have effectively done the hard work for you? So I think this definitely, for me, means that they will want to keep the option open at least, that they could look to hike rates in September. I don't think that they will do that, but I think that, as per usual, they'll want to keep every option on the table. Now remember, with the Fed, generally speaking, September and December are seen as the most opportune times for them if they were going to hike, because that's when they have the press conference, the updated dot plot matrix. Also, don't forget you've got the US elections in November. Highly unlikely they'll make any move over that period, so either before or after. So a couple things to contemplate there. The bottom line, though, as Bank of America has said, the absence of significant statement changes, FX moves are likely to be limited on the back of the Fed meeting. Again, I'm not expecting drastic moves in the market this evening. What I'm expecting is a slight nod to improved optimism in some of the US data surprises we've seen to the upside in the US. In terms of dollar strength, that's responded in part to the Brexit-driven safe haven demand more than anything else. But I'm looking for a cautiously optimistic tone from the July statement from the Fed. So we'll see whether or not that materializes. Okay, moving on. Two other stories just before we look at the day ahead. And one that is important, one we've been talking about since the beginning of the week, is Apple. They, of course, did report after the market closed yesterday. Their shares rallied 7%. That's a big move for a company that's the largest in the world, and hence you've had a bit of a positive read across into Asia overnight and to European equities this morning. The problem is, though, when you actually start to scratch beneath the surface, for me, Apple is worrying. Now, I've had a chat with Bill and Vas this morning, and I totally agree with the view that it's hard to go against stocks at the moment moving further north. We're still trading only a few ticks in the S&P from all-time highs, and while the music is playing, you've got to continue dancing. And the music is QE at the moment and other stimulus programs, and that is forthcoming. So to bet against higher equities at this point, I think is wrong. However, when I look at Apple, in the long term, not the short term, the long term, I do have major question marks about the performance of this company. I was asking myself, what Sony products did I have when I was young, and what Sony products do I own today? Now, when I was young, I had a Sony Walkman, the family had a Sony TV, we had a Sony Hi-Fi, and I don't know about you, I don't know what Sony products you have these days, but I don't have any. And it feels awfully like the situation with Apple. They went through a massive innovation period, as too did Sony with the Sony Walkman. They were on top of the world in terms of R&D and performance and revenue and sales, and yet the only thing now is that what have they really done other than, granted, the gaming world where they've moved into PlayStation and PlayStation 4, obviously the latest model. But other than that, you know, if you were to look at the size of the company in the 80s compared to now, it's a different ballgame. Now, when I look at Apple, the results, they pretty much missed on every single metric, and yet they rallied 7%. iPhone sales continued to decline, and they account for, I think, about 2/3 or 70% of the company's revenues and profits, and they fell again. The only thing is, they didn't fall as much as the market was expecting. But there's certainly a worrying trend happening at Apple, because their other products, like the watch, the laptops, the iPads, are also in decline. Now, one of the things here that Tim Cook, the CEO, was saying in a conference call with analysts afterwards is that they've now drastically increased by 26% the R&D that they're spending. You know, why is this happening now? This should have happened a long time ago. You know, a loss of competition to more cheaper products, particularly in the more populous areas of East Asia, I think is really key, and I do believe that Apple is way behind the curve on that. Looking at the Apple iPhone sales, they're the slowest since Q4 of 2014 at the moment. You can see here the darkest shade, that's the iPhone. And you're looking at iPad, you can pretty much draw a trend line more recently on each product is decreasing. Maybe the Mac, given its professional kind of target audience, is the only one that's been really consistent. But yeah, just my thoughts on Apple moving forward. Certainly them moving into apps is going to be key, as well as they're making their platform more integrated and interactive over the TV and internet space as well. Is going to be where their future kind of lies, I guess. But for me, I think this is the beginning of the end for Apple. But there you go, everyone has their own view. Final story I think you guys need to be aware of. Italian banking stocks yesterday. At one point, as you remember, Commerzbank pre-announced almost their earnings. They said about worrying capital positions. You've had Deutsche Bank this morning, which runs Europe's biggest investment bank. They said second quarter profit was almost wiped out as trading revenue slumped, and it set aside money to reduce jobs. Banks yesterday, I would say, were ranging from losses of around 3% to 8% when you take into account some of the Italian banks. It almost feels as though there's a little bit of pre-positioning going on, specifically in the banking sector, for those European stress tests that are coming out on Friday. Again, if you lower the bar, the market trades on expectation, not the actual event. So people are expecting some banks to fall short of their capital ratios, and as such, that's why we're seeing some of this downside pressure. Now, the important thing here is Monte Paschi is really key to this. This is that Italian bank that you often see written about in market press. The latest overnight then is that Italy have been racing to secure a privately backed bailout of Paschi, the most exposed of the country's troubled lenders, including a plan to raise 5 billion euros of fresh capital as to avert nationalisation, according to bankers and European officials. So again, it seems as though a lot of the Italians at the moment are looking to get something in place in order to appease the markets. So when on Friday we hear about how bad, let's say, the situation is with these Italian banks, there's already a solution put forward, and that they're going to inject capital into some of the weakest names. So this seems to me a little bit of front-running, proactive, let's say, interaction from the government and authorities to try and circumvent what could be downside for the banks to come. Okay, a quick look at the charts this morning. Obviously, as I said, the S&P still within striking distance really of these all-time high levels. I think that was the 72.5 type level. So trading around 5 ticks shy of that at the S&P at the moment. One thing, crude oil has been quite key the last 2 days in what otherwise has been a fairly quiet start to the week. Just quickly, looking at this move here in crude oil. Why did that happen? That was the release of the API crude oil inventories. In crude, we had a drawdown of 827,000 in the headline. That actually was not quite as an aggressive drawdown as expected, but it's the Cushing number which caused the downtick. We had a Cushing build of 1.4 million, which was double the street expectation. And remember, that was also larger than the Cushing number we had on Monday of 1.14 million. So the way that these inventory numbers have been lining up in the crude market is certainly for inventory builds, which would be bearish for prices. However, these haven't been sharply out of line, which is why I think you've had a bit of recovery to pretty much the pre-announced levels. Okay, finally then, quick look at the calendar for this session. (9:30) UK GDP. Any sterling traders, I'll be watching that carefully. Let's keep in mind though, this is second quarter growth, which is largely insignificant when the market wants to see the impact of Brexit, which would be after the survey period. So I wouldn't be looking for a drastic market movement in cable or pound, but nonetheless I would be keeping a close eye on that figure. Later, we're coming off the coattails of pretty solid US data at 3 o'clock yesterday. Although the service number was a little bit weak, consumer confidence riding high in the States, the housing sector continues to somewhat outperform. Let's see how durable goods orders, as the preliminary June number fares, pending home sales. Then of course we'll get the DOE oil inventories. The market then, likelihood, after the European cash close at 4:30, will go quite quiet, which is typically the case, and we start to run into one of the main events of the week, which is the FOMC statement. Again, only the statement. That will flash on the news wires to the 2nd of 7 p.m. this evening. The market will trade that. No conference with Janet Yellen this time. Okay guys, I'll let you get on with the session. Enjoy your day. Thank you.